So let's look at the second phase here. We've just looked at brokers and bankers and why they issue mortgages and why they package and resell them, why there's an incentive to resell them and not hold the risk and not have to fund additional loans. Let's look at who the buyers are of this. And if you'll notice here, there's a little blue star right here in the middle of both this, on this line where the mortgage security, bundled mortgage securities are being sold, and again here, which we'll talk about in a minute, when the people who buy the mortgage securities are then bundling and reselling them again. So this gets pretty complex pretty quickly. But so who is the buyer? Who is the buyer of the mortgage securities, these bundles of mortgages that banks really don't have an incentive to hold? Who's the buyer of those? Well, there's two main buyers for those. The first are what I'm calling GSEs, or government-sponsored entities, and the second is investment houses. And as of October 2008, this is probably not a reality anymore, as pretty much our large Wall Street investment houses have been dismantled or moved to normal banking entities. These government-sponsored entities are specifically Fannie Mae and Freddie Mac, as many of you have heard about these and may not understand them fully. The government-sponsored entities were created to facilitate free flow of capital in the mortgage market. In other words, to allow the mortgage market to grow and allow more people to be able to be financed to get homes. And the government felt that this was an important player so that banks had an incentive to generate mortgages for people to buy homes, because over the long term, homes are a good investment, and it's a good thing for people to own homes. It's not necessarily a good thing for people to own homes prematurely. And that's one of the problems that we've run into, which we'll talk about in more of a philosophical argument in a few minutes. But the government-sponsored entities, Fannie Mae and Freddie Mac, are the major players who buy repackaged mortgages. So what we're going to look at here is something that I call a demand pull in the market. There's a major, or has been a major, demand pull in the mortgage market that created more and more incentive for banks and brokers to generate mortgages. So as the mortgage market's grown, it's mainly grown because of a demand pull. In other words, someone saying, hey, I want more of that. Can you give me more of that? Can you give me more of that? I want another one of those. Can you please give me another one? And that kind of demand pull, the supplier would say, sure I can, sure I can, sure I can. I'm making plenty of money. And I'm a bank, I'm making plenty of money, I'm making fee money, I don't have any risk because I'm not keeping it on my books. So yeah, I'll give you all I can. And so this bank and broker network really expanded during the early and mid-2000s. The government-sponsored entities, Fannie Mae and Freddie Mac, had a charge from Congress, and in the early 2000s were also allowed to buy subprime mortgages, which are riskier mortgages. There's three classes of mortgages: prime, alt, something called Alt-A, which you may have heard about or read in the paper, and then subprime, which I'm sure you've heard about and read in the paper. Well, once Fannie Mae and Freddie Mac, under the authority of Congress, and we'll talk about that more in a second, were authorized to buy subprime package mortgages, then the banks and brokers obviously said, sure, we can do that too. And then looser underwriting standards and more creative financing tools appeared in the market, so more and more people were qualified for mortgages, many of whom we've done an amazing disservice to by allowing them to get into mortgage obligations prematurely, and unfortunately put off their real ability to get into a house and a mortgage off for many more years than it should have been put off. So the system, the demand pull, I believe, created that. The government-sponsored entities have an extreme benefit over a normal company in that there's an implicit guarantee that their assets are safe by taxpayers, and they happen to also be public companies, so people can invest in them just like any public company. But the big deal here is they had an advantage from a funding perspective. They could actually go out into the market and get funding at a cheaper rate because they had this government-backed guarantee, so they were less risky than other companies and could actually borrow at cheaper rates. Well, if you can borrow at cheaper rates in the banking business, you're going to win. And so the portfolios of Fannie Mae and Freddie Mac really ballooned, and then when Congress had the impetus to authorize them to move into the subprime arena, of course their portfolio grew even more into the trillions of dollars and many of those dollars being subprime in the last few years. There's also the investment houses that have a play in here, and these are were the big five investment houses: Bear Stearns, Lehman Brothers, Merrill Lynch, Goldman Sachs, and Morgan Stanley. And so these five investment houses also would buy these package mortgages. And remember, a package mortgage, what we're calling a mortgage security, there was an assumed cash flow. In other words, it was assumed that these people, at least a high percentage of these people, would pay monthly. And it's basically creating a bond here that whoever would buy these mortgage securities would assume that I'm going to get paid so many dollars monthly. Is this commercial paper, this is paper that was issued on a loan, and the customer is going to pay me back with maybe a small percentage of them defaulting over time. And that's an assumption we had to make. But there's an assumption that I'm going to get a cash flow out of these. That's what I'm buying. That's why I'm paying X dollars in order to get so many dollars in cash flow. There is an assumed risk per tranche. So if all these pieces of mortgage-backed security paper were sold, there's assumed risk on the level of risk that's involved. So if they're prime mortgages, you're going to make the assumption, and these are people with higher FICO scores, you're going to make the assumption that these prime mortgages are going to default at a lower rate. So there's more certainty that you're going to get your payment, your cash flow. The Alt-A mortgages, which are like the step down from prime, you're going to assume that you're going to get your cash flows. You may get the cash flows at a little higher interest rate because hopefully that when these were issued, there's a risk-return trade-off, so that when they were issued, this tranche of folks there's an assumption that they would default at a slightly higher rate, but that the cash flows that were coming in were also priced at a slightly higher rate, so the interest rate should be higher. And then, of course, your subprime, which is the lowest tranche of people who could be accepted for a mortgage. They were probably paying at a higher interest rate yet, and also were assumed that they would default at a slightly higher rate than the Alt-A versus the subprime versus the prime. So each one of these tranches, prime, Alt-A, and subprime, have, if you think of it, they have a set of assumptions that go along with the paper in those tranches. The assumption is that the interest rate is X, and the loan loss rate is going to be Y, and they're different for the different tranches. Very important to understand that. And then what happened is that one of the major things that's happened is once these cash flows and the risk portions were analyzed and understood here, there was another incentive, right, for the GSEs and investment houses not to hold that paper yet again, but to divide it and combine it and put it together and resell it again in the secondary market again, but this time to investors, because you had an implicit guarantee of cash flows minus certain amounts of risk that you could then package and say, hey, this is a bond, why don't you buy this? You're going to get 8% back guaranteed for the life of the loan. The average life of the loan may be 22 years. And so we're going to package this and sell it to the various investors. It could be pension funds or mutual funds or foreign funds and foreign banks. And again, these investors are making assumption about cash flows, they're making assumption about yield and risk, and there's most of these funds, pension funds, mutual funds, and foreign banks, they had rules dictating the level of risk they could take. So they probably wouldn't invest in certain things that were too risky, so there's an assumption that when they were buying these assets, they understood the risk, and they were buying cash flows, if you will. That's what they're buying future cash flows at a certain cost. So they're paying up front. Say you're paying $10,000 for one of these bonds, and you're assuming you're going to get 8% payment for 20 years. And this is something that these investors could do. Usually not individual investors, unless the individual investor was buying a specific mutual fund that invested in mortgage-backed securities. And in fact, that's one of the key things that triggered off kind of the initial, if you will, pre-earthquake, right, for this whole financial crisis was when in July of 2007, two of Bear Stearns, one of the investment house's mutual funds that had to do with mortgage-backed securities, went under. They couldn't redeem, people couldn't redeem their shares quick enough because the thing started to break down. And we'll have to talk through that at another situation.